So there's a lot of noise about AI, but time's too tight for more promises. So let's talk about results. At IBM, we work with our employees to integrate technology right into the systems they need. Now, a global workforce of 300,000 can use AI to field their HR questions, resolving 94% of common questions. Not noise, proof of how we can help companies get smarter by putting AI where it actually pays off, deep in the work that moves the business. Let's create smarter business. IBM.
When you're running a business, the best days are the ones where priorities stay on track. For midsize and large companies, that isn't always easy. Risk can touch multiple parts of an organization at the same time, often in ways that aren't immediately obvious. It might involve property, liability, or cyber. It could stem from regulatory requirements or challenges tied to a specific industry or the scale of an operation. At that level, managing risk becomes an ongoing discipline, not a one-time decision. At The Hartford, the focus is on helping businesses manage risk before it turns into something more disruptive. That means working with companies to identify where they're exposed, decide what matters most, and put practical standards in place so risk is managed as part of day-to-day operations. And when losses do happen, The Hartford can pair that risk control work with insurance coverage grounded in underwriting, risk engineering, and claims experience developed over time. Learn more at thehartford.com/risk mitigation.
From coast to coast, unlock adventure at Red Lion Hotels by Sonesta, where restful sleep, friendly service, and trusted local knowledge are part of every stay. Red Lion makes it easy to feel welcomed, comfortable, and connected wherever the road takes you. Whether you're traveling for business or pleasure, you can spend less and make more of every trip. When you sign up for Sonesta Travel Pass, you'll get their best rates instantly. Go to Sonesta.com to book your stay and unlock the best rates with Sonesta Travel Pass. Here today, roam tomorrow. Join now at Sonesta.com. Terms and conditions apply.
Welcome to Inside Active, a podcast about active managers that goes beyond soundbites and headlines and looks deeper into their processes, challenges, and philosophies in security selection. I'm David Cohne. I lead mutual fund and active research at Bloomberg Intelligence. For the better part of the last decade, the story in the markets has been simple. Passive is winning. But recently, that narrative has started to shift, and the question is whether that shift is real or just another cycle and a very long debate. Today, I wanted to look at that through a more thematic lens, what's actually changing, where active might have an edge, and what tends to get more competed away over time. So here to talk about that is Phil McInnis, Chief Investment Strategist at Avantis Investors. Phil, thank you for joining me today.
Thanks, David. It's a pleasure to be here. I'm excited about this.
So we're hearing a lot right now about, this shift back to active. What part of that narrative do you think is overstated or misunderstood?
I think there's a couple things that are really important to really contextualize it, because you have the types of strategies that are out there. You also have the vehicles through which people are accessing them. And so if we're talking about active relative to passive, I think right alongside it, you have to talk about ETFs and mutual funds, because for a long time, many of the ETF options or the predominant ETF options were passive of some sort, right? There was some sort of index-based mechanism. And so if we think about kind of market share there between mutual funds and ETFs, ETFs had around 14%, 16% market share. If we go back to, say, 2014, go back to a little bit more than a decade ago. If you think about, the end of last year, that split is a fair bit different, right? You got mutual fund share coming down. You got ETF share coming up mid-high 30s. So that's a pretty significant increase. If we think about that, kind of contextualize it with some net flows since 2020, I think around $2.5 trillion out of mutual funds and $4.8 trillion into ETFs. It's just a massive amount of money. So I think the concept of what vehicles are people choosing and then what is the kind of the strategy of those underlying vehicles is something that's pretty important to start with. Once you get into ETFs specifically and you look at the share of passive relative to active flows, that dynamic is shifting as well, to your point. So if we go back to 2019, I think it was less than 10% of flows were going into active. If you look at 2025, you're over 30%. So that's materially different. And there, I think that there is more options for investors for sure. But I think it has to be still contextualized of it's a big choice of the ETF vehicle over the mutual fund vehicle. And I really don't see that reversing.
So, I mean, market leadership, if we just think about the market right now, it's still pretty concentrated, a handful or so mega cap names. In this type of environment, most people think that passive tends to work well. Why do you think we're really seeing this push towards active right now?
I think there's a few different things because I think with passive, so I think about passive and active as being way more of a spectrum than like take a company like Meta, for example. Is it a value stock or is it a growth stock? According to MSCI right now, it's a value stock. According to Russell right now, it's a growth stock. So is that a passive decision or is that an active decision? Right there, even among indexes, if it's a non-total market index, I contend that there's still some form of security selection that is going on, right? You have to determine how are we constituting it as a value stock? What's our ceiling for a small cap portfolio or a floor for a mid or large cap portfolio? These are active decisions. And so if we look at the growth in indexing and where it's come from, I really don't think a lot of it has come from people stepping back and just buying the total market. That's happening, but not nearly to the same level as people are buying components of the market. That can be sectors, that can be styles, that can be market cap segments. It can be factors as well, right? Different sort of slices of the market that technically track an index. There's a set of rules, there's a methodology that you can go and read. And so the funds are tracking that index. But is that really passive? No, I don't really think that it is. I think that it might be passive in implementation, but there's still some active security selection that's going on. It's just a matter of who's doing it. So has it been concentrated at the top? Yes. What's really led to that? Two things. There's been really tremendous earnings growth at the top end of the market. And there's also been some pretty significant multiple expansion, right? So as fast as the earnings have come out, the prices have extended further beyond that. They've risen even faster. I think it's still a time where folks should not be overlooking the rest of the market. I would contend there's still plenty of really, really good opportunities that are out there where you can get a lot of the same characteristics that you might appreciate in a total market kind of passive strategy. You can get things like broad diversification, low turnover, low fees. Those options exist, but you can still pay attention to valuations, right? That's really one thing we try to center ourselves on at Avantis is paying attention to valuations. And so I think there's still an element of just not paying attention to price in isolation, not paying attention to fundamentals in isolation, thinking about those in concert. There's always a place for that in the portfolio.
So if we go a little further, I mean, Avantis is kind of known for its systematic, equity approach. How does that approach kind of change the way you think about where active, adds value? I know you mentioned valuations, but if you could go a little deeper.
Yeah. So the systematic piece of it, right? We get a lot of questions around, well, what does that mean? Does it just mean you're a quant, right? And I think even with some of these labels, and I'm going to sound maybe like a curmudgeon as it comes to all these labels, so I don't mean to, but I think sometimes you get categorized as a manager by things that you don't do relative to things that you do. So the fact that we are going and sitting across the table from CEOs and CFOs of portfolio companies and listening to them about their outlook for their respective businesses, and it's like, oh well, you must not be a fundamental manager. We care about fundamentals as much as anybody out there. I would contend as much as or more than anybody out there what the strength of the underlying fundamentals of businesses are relative to their prices, as if they're going to have a spot in our portfolio or not. But we're trying to do it in a really objective way. And so when I think about systematization, that's existed for a long time, right? It's existed ever since computers have been around, just to varying degrees and forms. If we think about kind of the market and options for people to invest and how that's evolved over time, it used to be everybody was just out picking stocks, right? There were stock pickers and maybe some things started to get systematized a little bit within there. But I would argue the systematization really started with indexing. Of people started to build indexes of, large cap indexes or small cap indexes, but really just looking at how big is the company in the market. That's the share it makes up of the index, and that's the share it makes up of your portfolio, and that's really it. That's now advanced a fair bit more, right, over a long period of time of different styles of indexes and different factors and things. So at Avantis, what we think about in terms of the systematization is there's parts of our process that if you can systematize it, you can do it faster, you can do it less expensively, right? You can do it more efficiently and potentially even at higher quality and better quality control checks and those things. So anything that we're doing at a very repetitive, repeated frequency, we try to make sure we have good systems in place to help us do that, to help us do it really consistently, really cost efficiently. Because going back to the days of just the pure stock picking, that's a pretty labor intensive and costly kind of an exercise to go and do this really deep due diligence on individual portfolio companies. So if I can systematize aspects of that and deliver a portfolio that's significantly lower fee, but still has that sort of bend toward valuations and having good risk management and everything else, we think that can be a really great deal for investors.
You mentioned, kind of a spectrum of, between active and passive. And, what do you think, and we also talked about the different things that are labeled as active today. And, that can mean quite a different things. What do you think, of what's actually labeled active today? What's generally differentiated versus just, repackaged factors, exposure? I know there's a lot of smart beta that, some consider active, some don't.
I think about this question in various forms a lot because I talk to a lot of allocators who are building portfolios, and they're building portfolios using all of these different types of tools and approaches together in a strategy, right? So they're using things that are index cores or index sleeves. They're using smart beta or factor based. They're using what would be considered maybe a more concentrated active strategy. They're using all these different things inside of a portfolio. And so where I come back to is that idea of, so around active, right? Because I think there's a really big piece as we think about around active is unless you are holding every stock in the market at its market cap weight, there is some level of active in your portfolio. And so you get into a matter of, well, who is making those decisions? Are you making them as an allocator? Is there an index house or another asset manager who's making them on your behalf? And as you think about the idea of, well, what am I trying to achieve with that allocation? What kind of risk am I setting myself up for as I'm taking that? Am I doing it in the most cost-effective way possible? Those start to become really important questions to answer, because the concept of like repackaged factor exposure being passive, right? I think the idea is like, well, if it's just factor exposure, that's kind of a passive exposure. I say that's really still quite active. All of those things are really active decisions. It's a matter of who's making them and then how cost effectively are they able to do it. So where I come back to, I think if you think about from an attribution framework, right? You can always do an attribution on a portfolio and see how much of it was an allocation effect versus a selection effect. But even once you're into that kind of attribution world, well, the attribution lens that I'm looking at it through, if I'm looking at it through a sector or through a specific set of factors or whatever else, I'm going to have different betas and different kind of alpha terms, right? So even all the models have their own biases that can be built into them. What I think about the allocator who is really on the hook for this decision at the end of the day. They have to think about, well, do I have a goal? Do I have a goal that I'm trying to outperform my benchmark by? And we could have probably an hour-long conversation just on benchmarking, David, so I'm not going to subject everybody to that today. But if I have a policy benchmark that we agree is reasonable, and then it's what's my goal in outperforming that portfolio benchmark, and how am I going to get there? I can do it by me, the allocator, trying to tactically overweight and underweight regions or sectors or styles or market cap segments that I think are more attractive or less attractive at different points in time. That's one option. I can put factors on top of it, right? I can lean towards value. I can lean towards quality or profitability. You have folks who do it that way, or I can outsource a lot of the stock selection to folks who are going and trying to find what they believe are the best companies. So build a portfolio of many concentrated active strategies and then look at my factor exposure and maybe try to offset some of it if I don't like it, right? There's so many different choices, but if you don't have a goal for what you're trying to achieve above and beyond that benchmark, then it's really hard to talk about what risk is and what risk looks like, because that concept of if I want to outperform by 1.5%, well, how much active risk do I have to take to make that a reasonable, achievable goal? And how much of that am I outsourcing the decision versus I'm keeping it? I have control. The more you have active managers in that camp, the more you're outsourcing it, and they may decide to do something differently, right? They may change the stocks versus what they had last quarter, last year, and that might change the way they look in the portfolio relative to what else you have. So at Avantis, one thing that's really important for us is we know anytime we're being hired, there's this trade-off between we're being hired to deliver that underlying asset class, but they're choosing us because they think we can do better than just market cap weighting within that universe. So we have to think about managing that trade-off effectively. And I would argue that we're as good as anybody out there at doing that, of making sure that sort of jobs 1 and 2 are design the portfolio so it does a good job of delivering that underlying intended asset class. And we do our job. We play that role in the allocation, but we have more information about differences in expected returns across stocks. And we can use that to not really meaningfully change the risk profile of the strategy. We might have some tracking error to a small value benchmark in our small value strategy, but it's not going to meaningfully contribute to an active risk or tracking error to the overall market level versus just using a small value index fund. So we think it can be a really effective tool for folks to use in those allocations. But the differentiation has to come through in that net of fee result at the end of the day.
So, if we think about what has to be true for an active strategy to, have some sort of durable edge after cost, you mentioned, having a research process and, is there things that, just have, that kind of contribute to being able to outperform over a longer period of time? I know that some managers might get lucky in some periods, but, like to have that durable edge, what else do you think goes into it?
I think there's 2 elements to it. I would say let's talk about process and then let's talk about costs. So on the process side, this probably isn't so well defined. So I'm gonna do my best to define it, and you'll have to judge, or I guess the audience will judge how
Sure.
well I define it. So I tend to differentiate between a manager or process that's really focusing on signals versus one that's focused on valuations. So if one is really, really focused on signals of I've identified something that I think the market is mispricing, and there's the signal that gives me that information, and so I'm gonna hammer that and extract a premium because of it, right? And they're constantly having to sort of rotate through what those signals are because they're being arbitraged away because other people are identifying those same signals and kind of crowding into those trades. That requires a lot of signals, and it requires a pretty high rate of frequency in terms of the turnover among those signals. So that process is one that I would say has a really high bar in terms of constantly having to refresh and find those new sort of areas of mispricing. What we do is much more grounded in valuations, and I would argue that that's a lot more stable and persistent, right? The chances of a relationship between a lower price company relative to fundamentals and a higher price company relative to fundamentals, of that premium over time flipping and going negative for long periods is not something that makes a lot of sense to me, right? The magnitude of those premiums may change, but the concept of if I'm paying a lower price to get the same level of equity and profits in a business, and over time I expect that to compound at a higher rate, I get better returns. I'm very comfortable with the long-term nature of that and conviction in that. So that's really the process piece. On the cost piece, there's a large asset consultant that threw out sort of a 2/3, 1/3. They believe that a manager should eat no more than 1/3 of their excess return. So I don't think that's an unreasonable kind of a bogey. If you think about a 2/3, 1/3 split, if the client keeps 2/3 and the manager keeps 1/3. At Avantis, so we've had strategies up since September 2019. If I look at the strategies that have been around, since that time, the split that we've given to investors is closer to 90-10, right? As far as 90% of the excess return going to the investors, 10% for Avantis. So I feel like we've done a really good job for investors there. Investors have gotten some really good value add from our strategies.
Do you think, I kind of want to just talk on the process a little bit more. If we talk about the edge, do you see that coming from a different place in 2019 versus today, or is it kind of still just valuations kind of driving that?
Yeah, so running these portfolios, right? There's a lot that goes into it. So, you think about the way we look at equity markets, and we've got, I think about there's different ways to describe it, but it's really a singular kind of foundation or view of being able to map or differentiate expected returns across stocks. We point that capability at different areas of the market. We've got large cap only portfolios, mid cap only portfolios, small cap only portfolios. We've got portfolios that just do it in the U.S. or do it in non-U.S. developed markets or emerging markets. So there's a lot of different sort of fishing ponds, right, where we're
Mhm.
applying this, but we have one way of fishing. That said, we're doing this across more than 14,000 companies, across more, 50 some odd countries every single day, right? So that's a lot of data that requires some really, really good systems and checks in place to make sure you've got clean data, that you're organizing it effectively, and that you're serving it up to really informed portfolio managers, investment people who can interpret the outputs of that and use it to make good decisions, right? So I would contend that you need to have expertise in all those areas. And I would contend that you need to be paying attention to all those areas because you don't know where the next edge is actually going to come from. It can come from many different aspects within that, but it takes all of it together working in concert to create a good portfolio, right? If we said, well, we've got really strong portfolio managers, but our systems are crap, that's not going to lead to a good outcome, right? You need all of it together. Sometimes people ask us that of what's more important. Is it the systems of the portfolio managers? And tongue in cheek, I say, well, what do you like most about a pizza, right? Do you like the sauce? Do you like the cheese? It tastes
Mm.
good because it all works together. And
Yep.
our portfolios, we think they work well because everything works well together.
So would you say, is there anything you think that investors underestimate about, how these portfolios are implemented, like whether it's trading, rebalancing, or costs?
It probably depends on the lens at which they're viewing it through, because I think they
Mhm.
could underestimate a lot. I think the biggest one, back to the earlier comment, is it's not a self-driving process, right? These portfolios aren't Waymos. So we've got somebody who's at the helm who is making sure, like, it's never going to be a computer or model that's sending orders to market. It's a portfolio manager who's looking at things and saying, is this reasonable? Does this make sense, right? We talked about wanting to systematize anything that we're doing with a very high rate of frequency so that you can do it more efficiently and do it more cost effectively. But there will be exceptions. There will be new things that pop up, and you need portfolio managers to be able to interpret those and make decisions and, surface them to the team. So I feel like that's one piece for sure. You can't just set it and forget it, not even close. But the other thing that I think, as it relates to systematic strategies and maybe even more broadly, the communication around them, I think, is really, really important. Setting and managing expectations effectively for investors, because it doesn't matter what kind of strategy you manage. If you're active, there's going to be a time when you underperform. And if you have taken a lot of shortcuts in how you explain the strategy, and you've just said, look at our Sharpe ratios, look at our information ratios, and just kind of smile and say, like, we've got good numbers. If folks are surprised by the results that have come out, then they might not stick around in the strategy. And in my mind, that's the worst outcome for everybody, because, they're hiring you when you got good returns. They're firing you when you got bad returns. And what did they get out of it? Right? Maybe not so much. We want people to hold these things for the long term, to be able to enjoy, the excess returns that we plan to offer, that these are designed to offer. So how we communicate around the strategies, being really clear about, this is how we take active risk. This is how much active risk we take. These are the environments where we're not going to do so well. 2025 actually provides a great example of that. You look at small cap stocks in the U.S. Is profitability, quality something that was rewarded? No, right? Not at all. Our small value strategy did not fare well in that environment. But as I was doing client reviews, we're sitting down with them and walking them through, here's what you hired us to do. These are the types of companies we focus on. This is what happened in the market or over this time period. They're okay, right? It doesn't mean we like underperforming ever, but it's reasonable and it makes sense given the broader market environment. We're not going to change our stripes because of a 6-month or 12-month period. So I think that communication is really, really important.
There's been some talk about systematic equity becoming more and more crowded. How do you avoid, these signals getting arbitraged away?
we talked about a little bit before around the signal. So I do differentiate or distinguish between the signals piece versus the valuations piece, right? So on the valuations piece, the idea that look, a company with a better price relative to its profits and its equity, do you expect those fundamentals to be rewarded over long periods? I'm very, very comfortable with that, right? And the beauty of our process is if I'm holding a bunch of companies that have those attractive prices to the underlying fundamentals, if a whole bunch of other investors show up and bid up those companies, the prices of those companies, and the fundamentals don't change, guess what happens? We sell them. We sell those companies, and we're going and reinvesting the proceeds into more attractive opportunities. So this daily process, right? The keeping our eye on the ball there is something definitely makes a lot of sense. But also, we are not chasing these really, really kind of fast moving signals. Trying to find a lot of elements of mispricing. Is trying to identify that value that is reflected in those prices and fundamentals. So I think there's some more staying power there. And every market where there's success, there's the potential risk of things being crowded by like a Me Too product or those kinds of things. We try to make sure we're resting on laurels of, look, this is what we focus on. This is what we're signing you up for. And then just doing our job, just making sure that you can count on us to do what we said we would do. Because I think in the investment world, that goes a long, long way if folks know they aren't going to be surprised by your results.
So the valuations, in a sense, kind of make sure that, as more and more assets get put in, the returns aren't getting competed away.
Correct.
Okay. And so if we switch gears a little bit, just talk about the ETF wrapper. We all know about the benefits, cost, tax efficiency, things like that. How much do you think the growth in active ETF reflects kind of really genuine improvements in outcomes versus just wrapper?
It's an important question. You look at 2025 as an example, 1,000 active ETFs listed, right? New ones. That brings us, I think, to around 2,800, according to a Morningstar report that I was looking at. So that's a number. That's a number of options. To contextualize the 1,000, I think somewhere in the neighborhood of like 100 passive ETFs or index-based ETFs and 150 mutual funds that were launched over that same time frame. So clearly, there's a lot that's going on in the active space. Now, your colleague Eric likes to talk about hot sauce. I think a fair number of those ETFs might fall under that hot sauce kind of label if they got a lot of leverage, if maybe inverse or single stock. So I think probably at least a third of the ETFs would absolutely fall within that category of those that were listed in 2025. And me personally, I do question if it's providing more choice. That's for sure. Investors have never had more, active ETF options than they've had today. And choice is not necessarily a bad thing, but is it choices that can really drive meaningfully good kind of outcomes for those long-term oriented investors? I'm probably a little bit more skeptical of that. I think you would have to dig deeper into the underlying thesis of each of those portfolios. With the commoditization, you see it in fees, right? Fees have come down significantly. If you look at where the money is going among active ETFs, it's not really going to high cost active ETFs. It's going to lower cost active ETFs. So that shift from mutual funds to ETFs that I would contend is absolutely about tax efficiency and things like the wrapper provides, but it was also just an emphasis on costs, lower cost ways of achieving the same exposure in a portfolio. So costs are still going to matter. I think they still should absolutely matter for investors who are evaluating these things. But I think you got to, with whether it's active, whether it's index-based, I don't know if allocators will like hearing this answer or not, probably depends on your role. I think you got to open the hood, you got to kick the tires, you got to understand how does the stock get into the portfolio? How is it weighted? And then when might it leave, right? And why would it leave? You have to understand that to understand the role it's going to play in your portfolio. The other thing I would say is you look at kind of ETF sponsors as somebody who's doing due diligence. I think it's a great question to ask people of how do you think about product development, right? What's causing you to bring new strategies to market, or why did you launch these strategies, or how do you think about it? You'll learn a lot about how they think about supporting investors as they think about developing strategies. So those are really important questions to be asking a sponsor.
So you had made you referenced the small value, as one example. How should investors kind of set expectations for different market environments, specifically for these type of strategies?
I love the question, and I think it's really important. So the way that I think about it, if you're evaluating a manager, um, I think that there's three questions that you really need to be asking, and before you start looking at any sort of MPT stats or a lot of data or anything else. So one is, so explain to me how you take active risk, right? How do you put names into a portfolio? Why do they make it in there? So you get an understanding of that process, right? How are you, and then how does that translate to adding value above and beyond the benchmark? So that's sort of component one. Component two, okay, what are you expecting to generate above and beyond that, right? So that gives them a sense of if they got an excess return target, and what's the tracking error that's going to come with that, right? What's the active risk that they're taking? So you have some semblance of that, and they should be able to show you, why is that a reasonable number or not, right? So does it make sense relative to what they're doing? What kind of periods are they going to underperform it? And then finally, what's the fee you're going to charge me, right? For that endeavor. So if you have those three things lined up, and do you think that cost is reasonable? If you have your head around that as an allocator, then starting to use attributions or MPT stats or whatever else can start to help you check and analyze and really see if it matches up relative to what the manager is telling you they do. And you can get a lot more comfort, right? But you have something like downside capture gets thrown around a lot, right? It's we got really good downside capture. I want a manager that has good downside capture. I can show you, or I can look at a downside capture number of a portfolio, and it might tell me a lot about the way that the manager is managing the strategy, or it might tell me absolutely nothing at all, right? Depending on how exactly they manage the strategy. Because think about 2022. If you had a portfolio that favored value at all in the US, it was going to look like you had great downside protection. Why? Or downside capture. Why? Growth stocks. Growth stocks were really what came down, right? They were falling down in price in 2022. So if somebody looks at that and said, I want this manager because they have good downside protection. Well, if I'm not managing it for downside risk, if it just was episodic based on that market environment, that number's pretty meaningless in that context, right? I shouldn't expect it the next time. So I think it's really, you have to answer those core questions so that you can start to form your own expectations of when should I expect this strategy to do well or not do so well? And am I comfortable with that, sort of range of outcomes? Those are the really important things to get across versus sort of coming with the objective first of I want this, and then I'm going to screen on those measures, and I'm going to get to a universe of strategies that provide that, and then I'll figure out which one is the best one. I'd always start back at the thesis first, right? How do these managers work first, and then see if it matches up with what you're looking for.
So my last question for you is, I know we covered this a little bit. We talked about how, a lot of launches recently, a lot of that is, leverage, single stock, you got defined outcome as well. And I guess it can be debatable if it's true active or, I like to separate them between, traditional active and new active. If we, think about the future and, 5 years from now, what would convince you that this was a true shift back to active, that the narrative was real and it wasn't just mostly noise?
So I have three components to an answer, and hopefully it's a satisfying answer. So the first one, back to kind of mutual funds and ETFs, right? So move away from mutual funds to ETFs. I would put a big stamp on that as validated, right? Like that. I don't think that's going back in the other direction. And so there is the component of, well, how are you defining active, right? Is it non-index, the non-total market index? Because I still put all those within the realm of active in some fashion. And so there, if you're, whether it's an ETF that is labeled active or an ETF that is labeled index, I think we got to dig a little bit deeper to be able to say which is the better way of doing it. With Avantis, we would argue. So if you look at costs, if you look at the level of diversification that's available in a portfolio, if you look at the turnover levels of a portfolio, we got a lot of portfolios that are pretty darn low fee, low turnover, pretty broadly diversified, really tax efficient with the ETF wrapper. That, again, I'd put a stamp on that and say validated. Like if I can check off those things, I think a lot of allocators are very happy to have those as tools in a portfolio, regardless of what the label is. So, we started in 2019. We had 5 ETFs at that point. We've launched a lot more. But I said earlier about, talking to a manager, how they think about product development. We don't launch strategies in hopes that people show up. We go and talk to people as to what else they might need and how we can help. And that's what's going to lead us as far as what's sort of next out there. So that, I think, is a much more sustainable way of growing a franchise of strategies that are available, solutions that are available to investors. And it served us well, it served our clients well. We're around 130 billion in total assets under management now, 6.5 years later. That doesn't come from, I would say being lucky. It comes from hopefully, doing what you say you would and having things that really embody all the characteristics of things that people want in a strategy. So I'm maybe cheating a little bit here in terms of that validation, but I like to borrow from both disciplines. I think there's disciplines of active management that make a lot of sense in a portfolio: daily oversight, emphasis on valuations and things. There's also elements that may be more often associated with passive, back to the broad diversification, low fees and things, that I also think are good components of a strategy. So we're going to have those embedded. If we can blend those effectively together, we think it can translate to really good outcomes for clients. And those 5 strategies that I was talking about, if you look at their average net excess return versus their benchmark, it's over 300 basis points annualized net of fees. So we again feel like that's a pretty good deal that investors have gotten, and we're happy to keep doing it for them.
Great. Well, unfortunately, we need to end here, but this was a lot of fun. I really enjoyed this conversation, Phil.
Likewise. Thank you, David. I really appreciate it.
Thank you for coming on. I also want to thank our listeners. If you liked the episode, please share it, subscribe, and leave a review. And if you'd like to see more of our research on the terminal, go to BI Fund Go for fund and active research. Until our next episode, this is David Cohne with Inside Active.
When you're running a business, the best days are the ones where priorities stay on track. For midsize and large companies, risk can affect multiple parts of the organization at once, from property and liability to cyber and regulatory challenges. At that level, managing risk becomes an ongoing discipline. At The Hartford, the focus is on helping businesses manage risk before it turns into something more disruptive. And when losses do happen, that work is paired with insurance coverage shaped by years of underwriting, risk engineering, and claims experience. Learn more at thehartford.com/risk mitigation. Policies provided by Hartford Fire Insurance Company and its property and casualty affiliates, Hartford, Connecticut.
A business gift should do more than check a box. It should reflect your brand and show someone they're appreciated, recognized, and truly seen. 4imprint offers thousands of high-quality, customizable products, like premium apparel, drinkware, tech, and more, making it easy to create a gift that feels meaningful and on brand. And with 4imprint's expert support and their 360-degree guarantee, you can be 4imprint certain your order will arrive exactly as intended. Explore gifting with confidence at 4imprint.com. 4imprint. For certain. Sonesta Travel Pass makes traveling more rewarding, designed to help you get more out of every stay. Sign up at Sonesta.com to enjoy instant savings, bonus points, and valuable perks like early check-in, late checkout, room upgrades, and free stays over time. With Sonesta Travel Pass, every stay brings you closer to your next reward. Choose from more than 1,100 hotels across 13 distinctive brands and unlock the best available rates when you book direct with Sonesta Travel Pass. Here today, roam tomorrow. Join now at Sonesta.com. Terms and conditions apply.